Time is more valuable than money. You can always get more money. You can never get more time. This is the single most important rule in investing. Most people think they need a lot of money to start investing. Wrong. They think they need to be a genius stock picker. Wrong again. The most powerful tool you have isn't your income or your IQ, it's your age. Where you are in life dictates your entire investment strategy. Your financial playbook at 25 should look completely different from your playbook at 65. Today, we break down the exact plays you need to run at every stage of your life. Your investment journey is personal. It depends on three simple things. First, your age. A younger person can afford to take more risks. They have decades to recover from any market downturns. An older person, closer to retirement, needs to protect their capital. Second, your goals. Are you saving for a down payment on a house in 5 years? Or are you saving for retirement in 30 years? The timeline of your goals changes everything. Short-term goals require safer investments. Long-term goals allow for more aggressive growth strategies. Ignore anyone who gives you one-size-fits-all advice. They are lazy. Finally, we must talk about risk tolerance. This is a fancy term for how well you sleep at night when the market drops. Some people see a 20% drop and panic sell everything. Others see it as a discount and buy more. There is no right or wrong answer here. It's about knowing yourself. Understanding your emotional response to risk is crucial. It stops you from making stupid decisions at the worst possible times. Your age, your goals, your risk tolerance are the three legs of your investing stool. Get them right, and you'll build a rich life. If you are in your 20s or 30s, you are in the driver's seat of your financial future. You have the ultimate unfair advantage: time. Time is the magic ingredient that fuels compounding and turns small, regular investments into a massive nest egg. Your primary goal is not to preserve your money, it is to grow it aggressively. This is the decade to take calculated risks because you have 30 to 40 years for your investments to recover from any market dips. In fact, market dips are a good thing for you. They allow you to buy more assets at a lower price, accelerating your path to wealth. Your mindset should be focused on accumulation. Every dollar you invest now is worth hundreds of dollars in retirement. The money you invest at 25 is more powerful than the money you invest at 35, 45, or 55. Don't worry about volatility. Don't check your portfolio every day. That's amateur hour. Your strategy is to set up an automated system that invests for you every single month, and then get on with living your life. This is the time to build the foundation of your financial empire. Forget about trying to time the market. Forget about picking the next hot stock you heard about from your cousin. You are not a Wall Street trader, and you don't need to be. Your path to wealth is far simpler. It's about consistency and leveraging the power of broad market growth. The S&P 500 has historically returned about 10% per year on average. By simply investing in the market, you can harness this incredible growth engine. Your focus should be on increasing your savings rate and automating your investments into assets designed for long-term growth. Do not get bogged down by analysis paralysis. The biggest mistake young people make is waiting for the perfect time to invest or feeling like they don't know enough. The perfect time is now. The cost of waiting is enormous. Starting with just a small amount is infinitely better than not starting at all. Your goal is to build the habit of investing. Once the system is in place, you can focus on increasing your income and funneling more money into your investment machine. In this phase, your offense is your best defense. Play to win. First on your list should be equity mutual funds. These are your heavy hitters. An equity mutual fund pools money from many investors to buy stocks in dozens or hundreds of companies. This gives you instant diversification. Instead of betting on one company, you are betting on the overall growth of the economy. For young adults, aggressive growth funds and large cap funds. Historically, these funds have delivered returns in the range of 12 to 15% per year over the long term. They come with higher risk and volatility, but with a 30-plus year horizon, that is a risk worth taking for the potential rewards. Next, consider a unit-linked insurance plan, or ULIP. A ULIP is a hybrid product that combines investment and life insurance. A portion of your premium goes towards your life cover, and the rest is invested in funds of your choice. This can be a good tool for disciplined, long-term wealth creation, while also securing your family's future. ULIPs can generate returns between 9 and 15%, depending on the funds you choose. However, be aware of the charges and the lock-in period. We'll discuss cautions later, but for a young earner, it's a disciplined way to invest. Finally, don't ignore government-backed schemes for tax savings and stable growth. The Public Provident Fund, PPF, is an excellent choice. It offers a government-guaranteed interest rate, about 7.1% currently. While this return is lower than equities, the interest earned is completely tax-free. The PPF has a 15-year lock-in period. Think of this as the stable, defensive part of your portfolio, providing a solid foundation and valuable tax benefits, balancing the aggressive equity side. Your strategy in your 20s and 30s is to go heavy on equities. A good allocation might be 80% in equity mutual funds and ULIPs, and 20% in a safe option like PPF. This mix gives you massive growth potential while providing a small cushion. The key is to start now, automate your investments, and let time do the heavy lifting for you. This aggressive approach early on will set you up for financial freedom. Do not be timid, be bold. Welcome to your 40s and 50s. These are often your peak earning years. Your income is likely higher than ever before, but you also have more responsibilities. You might be paying for your children's education. You might be managing a mortgage. You might be starting to think more seriously about retirement. Your investment strategy needs to evolve. Growth still matters, but now add stronger capital preservation. You no longer have 40 years to recover from a market crash. Start de-risking your portfolio gradually. Balance is the theme. The first tool, hybrid fund, also known as a balanced fund. Perfect fit for this life stage. They invest in a mix of stocks, equity, and bonds, debt. This built-in diversification helps cushion the portfolio against market volatility. If the stock market falls, the bond portion provides stability. Choose aggressive hybrids with more equity, or conservative with more debt. These funds can offer respectable returns in the 8 to 12% range. Next, get serious about dedicated retirement planning with the National Pension System, NPS. You can choose your asset allocation, equities, corporate bonds, and government securities. With market-linked returns, NPS can generate 9 to 15% annually, depending on allocation, plus tax benefits. While balancing growth, don't forget capital protection. This is where fixed deposits, FDs, come in. They provide a guaranteed return and protect your principal, typically 6 to 8% as of late 2025. While they may not beat inflation significantly, they offer stability and predictability. A well-rounded portfolio might be 50 to 60% in equity-oriented instruments, e.g., hybrid funds and NPS, and 40 to 50% in safer debt instruments like FDs and the debt portion of NPS. You're no longer swinging for the fences. Methodically build your lead and ensure a secure retirement. Once you cross the 60-year mark, retirement or semi-retirement, your financial priorities shift. Your primary goal is no longer wealth accumulation, wealth preservation, and income generation. Provide a steady, predictable income for living expenses. You cannot afford significant risks with your capital anymore. Safety first. Create reliable income streams not dependent on the whims of the stock market. You move from investor who contributes to beneficiary who withdraws, a critical change. Prioritize stability, liquidity, and regular cash flow over high growth potential. The game has changed. You are trying not to lose. Inflation is a silent enemy. 4 to 5% inflation can erode purchasing power over 20 to 30 years. Your portfolio cannot be all cash, nor all ultra-safe instruments. You still need some inflation-beating exposure, but manage it carefully. Deploy the bulk of capital in instruments with guaranteed or highly predictable returns. Design your plan to pay you a monthly pension from your investments. Structure finances for peace of mind, cover expenses, keep a buffer for healthcare, and live with dignity without financial anxiety. The Senior Citizens Savings Scheme, SCSS, is a must-have. Government-backed for 60+. It offers one of the highest small savings rates, currently about 8.2% per year, paid quarterly. It has a 5-year tenure, extendable. The Post Office Monthly Income Scheme, POMIS, pays monthly interest, credited to your account. Current rate is about 7.4% per annum, government-backed. Atal Pension Yojana offers guaranteed pensions up to $5,000 per month after 60 for those enrolled before 40. Let's talk about 3 concepts. The bedrock of any successful investment strategy, regardless of your age. The first is diversification. Not putting all your eggs in one basket. Spread your money across different asset classes. Equity, stocks, debt, bonds, government schemes. When one lags, another may lead. Smoothing returns. Young investors, diversify across different equity funds. Seniors, diversify across fixed income schemes. The second pillar is compounding. When you invest, your money earns returns. Compounding is when those returns earn returns. Slow at first, then it accelerates dramatically. Long-term investments like equity mutual funds and ULIPs can harness this power. Time, not timing, creates wealth. The third pillar is consistency via SIPs. A SIP invests a fixed amount every month, automates discipline, and enables rupee cost averaging. More units when prices are down, fewer when up, reducing volatility over time. One note on ULIPs. Be careful, watch the charges, premium allocation charges, policy administration charges, and fund management charges. These can eat into returns. Fund choice inside ULIP matters. Debt fund or equity fund. ULIPs are long-term with typical 5-year lock-in. To beat early charges and reap compounding, be ready to stay invested 10 to 15 years. We've laid out a clear, age-based playbook, from your 20s to your 60s and beyond. We've discussed specific tools at each stage, from aggressive equity funds when you're young to steady income schemes when you're retired. You now have a roadmap. But a map is useless if you don't take the first step. Before you jump in, ask, what is your age? What are your financial goals and their timelines? What is your true risk tolerance? Be honest with yourself. Your answers guide the right mix. Our allocations are guidelines, not rigid rules. Always assess your risk tolerance and investment horizon, and consult a qualified financial advisor for tailored planning. Don't let perfection stop you. Start with a simple, low-cost index fund. Automate a small monthly SIP. Starting matters more than picking the perfect fund. Set up your first investment, even if it's small. Wealth is about freedom. Working by choice, caring for family, travel, and pursuing passions. The plan is simple. The tools are available. The only question, what are you going to do about it? If you found this guide helpful, share it with someone who needs it, and subscribe for more no-nonsense advice on mastering your money.